Am I the only one that didn't know how powerful dividends can be? Welcome back to FutureVest. Today, we're diving into the world of dividends. You may have heard about companies that pay dividends, but what exactly does that mean and how can it benefit investors? Let's break it down with examples from both Canada and the US, plus a look at some North American dividend kings that have been rewarding their shareholders for decades. Dividends are payments made by companies to their shareholders. They are a share of the company's profits. Think of it like this. You buy a slice of cake, a share. When the cake is cut, profits are made. You get a piece of that too, a dividend. Dividends reward investors for holding on to their shares. They provide a stream of passive income, which means you earn money without actively working for it. This can be especially helpful during retirement. Companies typically pay dividends on a quarterly basis. This means that every 3 months, shareholders receive a portion of the company's earnings. These payments are a way for companies to share their profits with investors, providing a steady income stream. This means you get paid 4 times a year. Each payment is a reward for holding on to the company's stock, and it can be a significant source of income, especially for long-term investors. But how do you know if you're eligible? There are 2 important dates to remember, the record date and the payment date. The record date is crucial because it determines who is entitled to receive the dividend. If you own the stock on this date, you're in line for the payout. The record date is the day you need to own the stock to receive the dividend. It's like a snapshot of the company's shareholder list. If your name is on the list on the record date, you'll get the dividend. The payment date, as the name suggests, is when the dividend is paid out. This is the day you actually receive the money, either as a direct deposit into your brokerage account or as a check in the mail. Real estate investment trusts, or REITs, are another category. REITs own and operate income-generating real estate such as office buildings, shopping malls, and apartment complexes. By law, they must distribute at least 90% of their taxable income to shareholders, making them a reliable source of dividends. Diversifying your portfolio with dividend-paying stocks from these industries can provide a steady income stream and reduce overall investment risk. By understanding how dividends work and the key dates involved, you can make more informed investment decisions and potentially enhance your financial stability. Let's look at some real-life examples. In Canada, Toronto-Dominion Bank, TD, is a well-known dividend payer. It has a long history of sharing profits with its shareholders. Another example is Enbridge, a major energy company. They transport oil and gas and pay a reliable dividend. In the US, companies like Procter & Gamble, P&G, and Johnson & Johnson J&J are dividend stalwarts. They make everyday products that people use, leading to consistent profits and dividends. The power of dividend growth and reinvestment. What's better than receiving a dividend? Receiving a bigger dividend next year. This is a reality for many investors who focus on dividend growth stocks. Companies that are doing well often increase their dividends over time. As the company grows, so does the dividend payout, creating a win-win situation. Your income stream keeps growing, even if the stock price doesn't move much. Increasing dividends provide a steady and growing income stream. Reinvesting your dividends can supercharge your returns. By reinvesting, you buy more shares, generating more dividends. This strategy allows you to take advantage of compound interest, where dividends earn dividends themselves. It's like a snowball effect. Your investment grows faster because you're earning dividends on your dividends. The power of dividend growth and reinvestment is remarkable. It allows you to build wealth steadily and reliably. Dividend kings, the royalty of income investing. Some companies are known as dividend kings. These are companies that have increased their dividends for at least 50 consecutive years. Talk about consistency. Some examples of dividend kings in North America include Coca-Cola, Colgate-Palmolive, and Johnson & Johnson. These companies have proven their ability to navigate different economic conditions and still reward their shareholders. What makes dividend kings so special? They tend to have strong brands, efficient operations, and a commitment to returning value to shareholders. Taxes and dividend yield. It's important to understand the tax implications of dividends. When you receive dividends, they are considered income and are subject to taxes. In Canada and the US, dividends are taxed differently than regular income. For instance, in the US, qualified dividends are taxed at a lower rate compared to ordinary income. In Canada, eligible dividends receive a dividend tax credit. Another important concept is dividend yield. This shows how much a company pays out in dividends each year relative to its stock price. To calculate dividend yield, divide the annual dividend payment by the stock price. For example, if a company pays an annual dividend of $2 per share and its stock price is $50, the dividend yield would be 4%. While a high dividend yield might seem attractive, it's important to be cautious. A very high yield could be a red flag. Sometimes a very high yield could indicate that the company's stock price has fallen significantly, which might be a sign of underlying problems. Therefore, it's essential to look at the overall financial health of the company and not just the dividend yield. Diversifying your investments can help mitigate risks. For long-term investors, focusing on companies with a history of stable and growing dividends can be a more reliable strategy. To sum it all up, dividends, a path to financial freedom. Dividends can be a powerful tool for building wealth. They provide passive income, the potential for growth, and a way to participate in the success of companies you believe in. Remember, investing involves risk, and dividends are not guaranteed. It's essential to do your own research, understand the companies you're investing in, and consider your own financial goals and risk tolerance. If you enjoyed this video, please like, subscribe, and stay tuned to FutureVest for more insights into investing and financial growth.